Hi, Clint Coons here with Anderson Business Advisors and Law Group. And in this module, I would like to discuss the benefits of using a qualified retirement plan over a self-directed IRA when it comes to real estate. Now, many of you are unaware of the issues real estate investors will face when they attempt to use a self-directed IRA to buy and sell real estate or just to buy and hold. And the reason that is that many of the custodians or the third party administrators, those individual groups that offer self directed IRAs, do not tell real estate investors the truth behind the actual structure they're creating. Now, there are a number of problems with self directed IRAs right now that the IRS is starting to focus on. And so, what I'd like to do is walk you through some of these problems so you know what to look out for when you deal with a self directed IRA custodian, so you get an idea of whether or not they're telling you accurate and relevant information. For example, just yesterday, I spoke to an individual who called in who has listened to some of my YouTube videos, and he's been to my blog and read many of the articles which I've posted about self directed IRAs. Now, he's working with a company, and I will name it's called Equity Trust. Now, right then and there is a problem because Equity Trust is under an injunction by the Securities and Exchange Commission from actually setting up any new IRAs. And this happens to be a result of them assisting people in a Ponzi scheme. But you can read about that online. But, anyways, he's working with Equity Trust, and what they told him is how he should take down a property. And this particular property that he wanted to buy in a self directed IRA was actually just entered into a contract was entered into between the individual spouse and a bank. So it's an REO property. And what Equity Trust said is that even though your wife has entered into this transaction to buy it in her own name, what you can do is you can assign the contract over to your IRA and allow your IRA to close. Now, he called me and said, "Can I do this?" Well, absolutely not, was my response. And here's why. I said, if you put that transaction together now, your wife has just given your IRA a benefit, and that is considered to be a prohibited transaction. If you're audited, and there's a strong chance you will be audited because the IRS has stated that they intend to focus on real estate held inside of IRAs. I mean, it's obvious they changed the form 5498 where your IRA custodian now must tell them if your IRA owns real estate or an LLC or a corporation. And they went so far last year as the IRS came out with a pronouncement wherein they stated that they are specifically going to focus on those IRAs that own real estate or limited liability company interests. So I said there's a strong likelihood this transaction will be audited at some point in the future. And what they're going to look at is how the whole transaction was put together. If they can show that your wife had the right to close on the contract and she assigned it to your IRA, that is an impermissible contribution to your IRA by a disqualified person. And that disqualified person is your spouse. So by doing that, what you're risking is every asset in that IRA, because the minute you involve yourself in a prohibited transaction, that is the day in which you lose the benefits of the IRA forever, and it's gone at that point in time. Now, he did not understand why his IRA custodian told him he could do this. And they didn't just tell him, they put it in writing that he could do it. He said, "Why would they tell me in writing that I could set up the structure this way?" I said, "It's simple. It goes down to who you're talking with. You're not talking with an attorney. You're not talking with a CPA or a certified professional who understands how these transactions should be put together. You're dealing with a salesman many times, or just a support person who does not have any professional designations. And so what they want to do is ensure that you're a satisfied customer. And the way to make you and keep you as a satisfied customer is to tell you yes. Because each of us want to hear the word yes when it comes to investing, that yes, you can do this. Yes, you can put a deal together like that. We don't want to hear no, because then it doesn't work with what we've created. Well, I'm here to give you some no's and some yeses. So in that particular case, it would not work, I explained to him. I said, you need to enter into a contract directly with the institution yourself, not yourself, between your IRA and an institution. Now, that brings up a problem, of course, and that is, in order to put that type of transaction together, he has to get Equity Trust to sign the paperwork, because a self-directed IRA, at its very heart, it's not self-directed. I laugh every time I hear somebody talk about a self-directed IRA, that they're considering rolling their traditional into this self-directed IRA. And I tell them, you already have a self-directed IRA. They say, no, I don't. I said, sure you do. You have an IRA with Charles Schwab. Can you not go in and buy and sell stocks on a daily basis, buy options? You choose when those transactions take place. I don't think you're in a situation where if you want to buy stock in Microsoft, you have to call up Charles Schwab, be put on hold, and then tell them to put that deal together. No, they give you that control to do it yourself. Well, with a self-directed IRA, you don't have that control. There is no control with a self-directed IRA. In fact, there's less control with a self-directed IRA, and that's just a marketing term, by the way. Because with a self-directed IRA, if you want to engage in a transaction, you can't do it. You have to use your third-party administrator or your IRA custodian to take care of it for you. I recently saw this on the internet from a third-party administrator that sets up self-directed IRAs. They said, come open up an account with us and gain control over your self-directed IRA. And here's how a transaction works. And it started right here with the individual, and it had this windy road that went like this. And they made this scene where, here's a tree right here and a road sign. You find the deal, you call us here, and then we contact the seller. And then the paperwork's drawn up here, and this happens over here, this happens over here, this happens here. And then your IRA now owns the property. I looked at that. I said to myself, you know what? If I was trying to convince people to come and set up a self-directed IRA, the last thing I want to show them is that it's going to take them on this long, curvy road in order to get from here to here. Because wouldn't you rather be in a situation where you jump on the interstate and you get there in 1 day or 1 hour or in 5 minutes? I think so. I don't have time to do all of this, nor am I inclined to do this with my real estate investing. But that's the marketing of this industry. They tell you that you gain control when in reality you do not have control. Because with a self-directed IRA, you have to use them for all of these steps. Because if you were to step in there and start handling all these transactions, the IRS considers that a prohibited transaction. You overstepped your bounds. So with self-directed IRAs, they're truly not self-directed. Okay, what they do allow you to do, though, in fairness, is to buy alternative investments. So in my example with Charles Schwab, now you have self-direction with Charles Schwab, but it's only with their investments. And we know that we don't want to be limited to the stock market. We want to get involved in real estate. So in order to do that, we have to step outside. We have to work with a third-party administrator or custodian that allows us to buy real estate. But when we oftentimes get involved with it, we find that this isn't what we thought self-directed meant. And so we feel like that the rug was pulled out from underneath us, that we weren't given the full story. Well, I'm here to give you the full story on how self-directed IRAs work, and then you can make a decision if you want to proceed forward with your self-directed IRA or not. So this has been a problem for the self-directed IRA industry. And so what they've done is they've come up with a solution. Some people got together and said, wow, our clients aren't too happy because they want to put the deals together. Number one, they don't want to pay us to have to get involved, which all of those transactions can be a fee along the way. And the other problem that they run into is this. If they're out on a Saturday and they find a deal, they want to close on it right away. But we're only open Monday through Friday, and depending on your time zone, 9 to 4. And so they have to tell the seller, ask the seller to hold that deal for them until we can get involved. And that's hopefully they can get a hold of some money, because Monday's our busiest day and we may not be able to return their phone call until Wednesday. So this has been a problem, and people started rolling out of self-directed IRAs because they realized I cannot control my funds and I can't get a hold of my IRA custodian to get my deals put together, and it's costing me too much money. So in reaction to that, what the industry did is they said, here's what we're going to do. We're going to give you the control we promised you initially by creating a limited liability company right here. So they set up an LLC like this. Now the LLC is owned 100% by the IRA. And this LLC has a single member, which is the IRA. That's why I said 100%. But the manager of the LLC is the IRA owner. So this is you. You are the manager of your LLC. Now, what they do then is take the money that you have inside of your IRA, your custodian will wire it into the LLC's bank account that you set up, where you're the only signer of. Now, when you find this house that you want to buy over here, your LLC can negotiate to purchase that property. And you can handle the entire transaction because it's no longer the IRA doing it, it's the LLC doing it, which you control. So you can write the check, you can sign the paper, you can do everything. So, see, now we have true self direction. You couldn't get it just with the IRA, you had to add this additional piece to it. So, if you're thinking about a self directed IRA, this is the way you're going to have to go down the road is you're going to have to create an LLC that's owned by your IRA in order to get this benefit. Now, here's what you need to watch out for. So, what's occurred in the industry is that in order to set this up the right way, you need to do this. You have owner of IRA right here. You need to set up your self-directed IRA over here with this, your third-party administrator. Then you roll the money into here like this. Then once this is set up and the money's here, then you set up an LLC here that is owned by your IRA here, and then you roll the money up. Now, this step is the critical step that most people screw up. I would say 85 to 90% of the deals that I see set up this way are deficient. And you're going to understand now why the IRS is targeting this. So what happens here, in order to create this LLC, and I've done a number of these for clients over the years, they want to pay me. They say, Clint, how much is it to set up this LLC? And you have to know this too. This LLC is not a legal doom LLC. It's not a standard limited liability company you're using in your own name. There are very specific provisions that need to be inside of that limited liability company operating agreement to ensure it comports with 4975 of the Internal Revenue Code and that does not trigger a taxable event or a prohibited transaction for you. There was a situation last year where an individual investor found out that he blew his IRA because of the way the LLC was set up, because the custodian was trying to play attorney and they didn't know what they're doing. So here's what happens. You want to set this LLC up. The way you do it is you hire Clint. This is me. Okay, so you hire me to set up your LLC. But the thing is that your money to set it up has to come from the IRA itself. It cannot come from you. If it comes from you personally to me, then what you're doing is you're making, or to your custodian, you're making a contribution of that LLC to your IRA, and that's a prohibited transaction. You cannot contribute an LLC interest to your IRA. The only thing you can contribute is cash. I mean, you know this. You may have not thought about it at this level before, but if you had stock in Microsoft in your own name, let's say it was valued at $6,000, you couldn't just walk up to an IRA custodian and say, here's my $6,000 contribution for this year, put it in there. They wouldn't accept it. They would only allow you to put in cash. But somehow their brain gets a little fuzzy when it comes to this structure right here. And what you find many times is that this doesn't follow in this manner. What happens is individual sits down at a seminar or something with salesman over here, and salesman over here says, oh, you want to set up a self-directed IRA? Great, we've got a self-directed IRA for you. You're right here. What I'll need you to do, though, is pay me $1,500 to set up your self-directed IRA. And what we're also going to do with that IRA that we set up for you, we're going to set up an LLC for it as well. So what you're paying for is a self-directed IRA, and you're paying for a limited liability company to be set up to be owned by your self-directed IRA. That is a prohibited transaction, and it happens time and time again across this country. Now, this right here is why the IRS, as I stated earlier, came out and changed Form 5498. You can pull this up on the internet. Look for IRS Form 5498. This form is the reporting form that your IRA custodian is required to submit every year with respect to your IRA. And what it does is it tells the IRS what your IRA owns. So they have to report on what's held inside of your IRA and specifically the value of those assets. So again, here's something where it's another problem that's just creeping up over the hill that people don't realize yet. So you have to tell them what's held inside of here. Now, when they came out with the new revised form, they added some boxes down at the bottom, and they want to know, does this IRA own real estate? Does it own an LLC, corp, trust? Does it own notes, tax liens, deeds, things like this? Anything that's not traded on the stock market, they want to know if they're held in this IRA. Now, why do you think, okay, put on your thinking hat here for a minute and say, why do you think the IRS changed their form 2 years ago in order to ask these specific questions about these types of assets? It's because they want to target individual real estate investors who are using self-directed IRAs. There's no other question about it. You've already seen the beginning of this tsunami of audits that are about to descend upon real estate investors, and it's going to begin this year. Now, here's what happens if you get caught up in this. The day you entered into a prohibited transaction is the day you lose your IRA. From then on, it's disqualified. So anything that you generated inside of that IRA is all taxable to you, plus penalties. If you have an IRA that's disqualified, you can be paying up to 60%, 70% of that money out in taxes. You blew it. You don't want to be in that situation. Not only is that a problem in taxes, it's also a problem with asset protection. There's been a couple of cases in the past year where people had IRAs and they were involved in lawsuits or they went bankrupt and they thought that their IRA was protected because so many people will tell you your IRA is protected in bankruptcy or your IRA is protected if somebody were to sue you. And that's partially wrong there because it depends on the state in which you live in. But let's just take the bankruptcy one to begin with. Well, if you go bankrupt and I'm the bankruptcy trustee, what I'm going to do now is what these other trustees have been doing. I'm not going to accept face value that your IRA is protected from me. I'm going to look at what you've done inside of your IRA. And if I find that you've committed a prohibitive transaction, you've done something that you shouldn't have done with your IRA money, then I'm going to disqualify it. And if I can have it disqualified as of that day, then it now is lost to you and it becomes my money. But you still have to pay taxes on it, by the way. So this is the problem you face when it comes to dealing with self-directed IRAs is that if it gets disqualified, then you've lost the tax-deferred benefits and you'll pay taxes on that money, of course, when it comes out to you, and potentially it's going to go to a creditor. So there's problems there with self-directed IRAs that people aren't talking about. So you have to be really careful how you utilize this tool for your real estate investing. Another problem we have is just generally taxation of IRAs. You know that if you buy a piece of property inside of an IRA and you need to use non-recourse funding, because you'll be told this, you can use debt inside of your IRA. That's right. You can go out and buy a piece of property and you can leverage it as long as you don't sign personally, because if you did, that's a prohibited transaction. But let's assume that I buy this property for $100,000. And that property that I bought for $100,000, I had to get $50,000 loan from a third-party lender over here. This guy loaned me the $50K. My IRA had the $50K in it, so we bought this property. Now, I've seen a ton of these deals go down this way. Now, this property, let's say it's cash flow rich, and it generates let's say $30,000 a year in positive cash flow for you. Now, you're going to probably think because it's going into your IRA, you don't have to pay taxes on it until you pull that money back out. Or if it's a Roth, you'll never have to pay taxes on it because, heck, that's what IRAs stand for, right? Wrong. Of course, you figured I was coming to that. When you borrow money and you utilize it inside of an IRA in this manner, then it's called debt financed income or unrelated debt finance income. You can look up this term if you'd like, UDFI, unrelated debt financed income. Then it means that the proportion of debt to this income or the purchase of the asset, which in this case it was 50% because the IRA put in 50 and we had to borrow 50. So 50% of the purchase price we use debt for, then 50% of this income is taxable to your IRA and it's got to file Form 1099. Now, people don't do this. They've not been filing these taxes. They have debt encumbered assets inside of their IRA and they were unaware that they're required to pay taxes on that income. And here's the kicker that really gets you. When you get up to this amount, $15,000 in earnings, you're at a 39% tax bracket inside of here. Yeah, you're at the highest marginal tax bracket at that type of level of income. $15,000, you're paying 39%. Wow, this doesn't seem like it's that great a deal anymore, does it, when it comes to a tax-deferred nature of utilizing this structure? But it gets even more interesting with the self-directed IRAs that they're not telling you. And that has something to do with this. Let's say you want to flip real estate. So I set up my IRA to flip homes. All right, so I'm going to go out there and flip. I'm amazed at how many real estate investors I talk to that look at me and they don't understand this deal. They would agree with me on this, that if I did this in my own name, if I flipped property in my own name and I did several deals, I could be classified as a dealer. Now, if you're classified as a dealer, that means you're in the business of buying and selling real estate. So, of course, it's taxable too, as if it was inventory in your hands, like you're selling cars. But for some reason, people accept that they're a dealer here and this is an active business. But when they do it up here, it's no longer an active business. And I ask them, I go, what's the distinction between the activity here versus here? Because it's done in my IRA? No, 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 no. It's still the same activity. It doesn't matter where it's done. It's still dealer activity. If you're flipping properties here or flipping properties here, it's dealer activity. And so the result is that if you flip a bunch of properties in your IRA, then the income is taxable. It's taxable to your IRA. And if you want to look this one up, it's called UBIT. Unrelated business taxable income, or some people will call it unrelated business income tax. Look up that term as well, and you'll know what I'm talking about. That if you run an active trader business through this IRA, then you will be paying taxes on that income. It's not prohibited. You can do it. You just have to be ready to pay the taxes. So this is what the IRS is focusing on. Not only people that have set up real estate inside of their IRAs and done just crazy stuff like paint the house, pay for the LLC themselves, go out there and do any rehab work on the property, lend their services to maintain the property in some form or manner, collecting the rents. And those are prohibited transactions that'll get them into trouble. But they've also engaged in taxable events. And so there's a two-pronged approach now that the IRS is focusing on when it comes to self-directed IRAs. They're in the crosshairs. There's no doubt about it. Nobody can dispute it. You can look it up on the internet and you'll find out that the IRS is looking at this tool. So if you want to use a self-directed IRA, you have to make sure you're setting it up the right way, dealing with a reputable custodian or third-party administrator, and you understand that, or they understand that the information they're providing you is accurate and relevant to what it is that you want to do. That the people that you're talking to are CPAs or attorneys, individuals who have a license to protect, that are not willing to just give you whatever you want to hear. If they're going to tell you yes, that because they want to keep you as a client, that may be a problem there. Every once in a while, they should be telling you no. But these situations come up, like I said, time and time again. I'll give you one more example of that, a prohibited transaction that really blew my mind because this company was actually dumb enough to put it not only in writing, they drew out a diagram. So this individual that came to me has a self-directed IRA again, has $300,000 in cash, but wants to do a flip in their own name, and they need that cash out of their IRA. So they know they can't loan it to themselves. I mean, they could take it out for 60 days, but it might take longer to do this flip because they have to do a lot of rehab work. So they wanted a creative way to get the money out to themselves. Now, what this IRA custodian, one of their salesmen, told this individual was in order to get the money out, you have to use an unrelated party. And what you should do is get your cousin over here, have your IRA, we'll set it up for you, we'll loan the money to your cousin. And then this person's down here, which is the owner of the IRA, and then your cousin will loan the money back to you. You do it through this mechanism right here, you can get access to your money and it's completely above board and legal. That was put in writing and was drawn just like that. Now, I hope those of you that are watching this video can see the problem with this type of transaction. This is form over substance. Okay, the form of the transaction is to get her the $300,000. Okay, or the substance of the transaction is to get her $300,000. But we use this form here of a straw man to do it. So there really was no intent to loan him $300,000. The intent was to give him the $300,000 so he could give it to the IRA owner. This is the problem that people face, and this is why the IRS is going to be hitting these things so hard. So with self-directed IRAs, you not only are subject to taxation, you have problems that if you're involved in a lawsuit, they can take them from you because you screwed up some point down the road with these plans. The other drawbacks to them, you can't borrow from them. Let's say you need some money out of your self-directed IRA. Well, unfortunately, you can't borrow from it. So that's a problem. If you and your spouse each have an IRA and you want to invest together, you have to set up separate self-directed IRAs. You can't pool your accounts together inside of a self-directed IRA, so that's more money that's going to cost you. You have to set up LLCs to get true control. So again, that's more money to maintain this structure and more things to go wrong, of course, when you're running it in this manner. So self-directed IRAs, I mean, they can work. And I often tell people, hey, if you're just going to buy a house, hold on to it long term, then that's what I would do. I would set up a self-directed IRA, hold the house long term, let somebody else manage everything. You just sit back and let the rent come in. But if you want to be active, buying tax liens and deeds, going out to auctions, wholesaling, well, actually, you shouldn't do any wholesale through your self-directed IRA. But if you want to flip properties, then you should not be utilizing this tool because there's so many areas that could get you with it. So the solution oftentimes that eludes people is to set up a qualified retirement plan. And in my next module, I'll talk about the benefits of a qualified retirement plan, why that may be more beneficial to you than utilizing a self-directed IRA, because there's just too much risk now with the IRS, and because so much has gone wrong with these structures over the past 12 years. It's something I would do. I would shy away from them rather than encourage my clients to set one up until there's been some stability and we've seen what's gone on with the market and I mean with the IRS and their audits. But on top of that, one other last point I want to leave you with is that buying real estate in your IRA can also create additional problems for you down the road when you want to retire. A lot of people get into real estate because they want to build up a retirement income off the cash flow. Well, when you reach 70 and a half, you have to start pulling money out of your IRA. And I'm working with a client right now who's in this problem. They have an IRA with several properties inside of it, like this. But the problem with their IRA is that it only produces, let's say, $30,000 cash, but after expenses. But the RMDs, the required minimum distribution that the IRS states that you must take beginning at age 70 and a half, is $65,000 a year. So you see there's a gap here. They don't have enough money from their real estate in order to cover this. So their question to me is, what do we do when we don't have enough money to cover our RMD because it's all tied up in real estate? The answer is sell. But they don't like that answer. They don't want to sell because they bought it. They want to hold it long term. It's a great investment. But unfortunately, they're going to be forced to sell unless they find a different solution, which there is, and which is something we're going to talk about in the next module when we talk about QRPs. There is a solution to this problem. And it's a simple solution, one that if you did it with your IRA would be considered a prohibited transaction. If you want to learn more about this, come to our website at andersonbusinessadvisors.com and request a free consultation with one of our professionals. We'd be glad to discuss with you the benefits of a self-directed IRA versus the problems with a self-directed IRA and how it can be used in your investing effectively. And we may give you some other solutions as well to consider. My name is Clint Coons with Anderson Business Advisors and Law Group, and I look forward to speaking with you at some time in the future. Take care.